Okay, in this video, I'm going to talk about modifying endowment contracts, MEC. First of all, what is a MEC? MEC is a life insurance product. The reason you want to know, so if a life insurance is considered as a MEC, so with a MEC status, means that any withdrawal from the policy, this includes loans, partial cash withdrawal, pledged as a collateral. So any of those things you're doing with your life insurance will be taxable as an ordinary income for these withdrawals and on a LIFO basis. So we're going to talk about LIFO basis later. So first of all, the withdrawal going to be taxed at ordinary income. Then if you are the owner, you're younger than 59.5 years old, then you make the withdrawal. You on top of the tax, you're gonna have additional 10% early withdrawal penalty. So that's why you need to know. Then for single premium contract, MEC withdrawals or loans is subject to MEC withdrawal, especially those contract is post August 1982. So single premium contract is a MEC. So when you make any withdrawal from those single premium life insurance, then you have to consider those. You have to pay tax and the penalty on it. However, the policy death benefit when paid typically remaining income tax free. So basically this says, well, if you buy a single premium life insurance, you won't touch it until the insured die. The beneficiary receives the death benefits is income tax free. That's always true. However, if you make any withdrawal during the lifetime of the insured, which is insured still alive, then you are subject to tax. So all the MECs issued by the same company to the same policyholder during the calendar year will be treated as a one contract. The reason you want to know this because there's a test then to find out if it's a MEC or not. So taxable as an ordinary income on LIFO basis. What does this mean? So basically, proceeds from the distribution will be taxed first as the ordinary income to the extent that cash surrender value exceeds the investment in the contract. So basically say, well, if you originally paid the basis, so you are not taxed on that. But any earnings, you will be taxed as ordinary income. However, your earning gonna coming out first. Anytime you withdraw, is LIFO, last in, first out, which is the earning gonna coming out first, which is the withdrawal at the beginning always being taxed if there's earning on it. Further, if the policyholder withdraws more than the earnings within the contract, then the distribution begins eating the basis. And the basis in the contract will be reduced. This will affect the taxation of the future withdrawal or loans. So basically, well, if you in the future, because you basis is lower, so anything above that, so it's gonna be taxed. So anything is like that. Okay, so now you know why you want to pay attention to MEC. So make sure your life insurance policy is not a MEC, especially if you are universal life, because you have the flexible, payment, flexible premium payment, you make sure your policy is not going to be categorized as MEC. So we have the test to find out if your policy is a MEC or not. So a MEC is a life insurance contract that meets both the state's law definition and the IRC definition of the life insurance contract that fails the 7-pay test. We're going to know what is 7-pay test. So a policy is classified as a MEC if the policy deposits equivalent of more than total annual premium payments either each year or cumulatively at any time during the first 7 years. Okay, what does this mean? Let's see an example. If a policy annual premium is $2,000, the total maximum in the deposit in the year 3 cannot exceed the $6,000. Well, let's say, the premium is $2,000 per year, right? So for 3 years, you should have maximum $6,000 in it. So for 3 years, they will look at the 3 year. If your premium is more than $6,000 in it, so then your policy can be a MEC. So if you deposit were $1,000 each for in the year 1 and in the year 2, then the maximum amount that can be deposited in the year 3 is still avoid a MEC is $4,000. So you can see, in the year 1, year 2, you only deposit $1,000, so that total is only $2,000, right? But your premium is allowed is $2,000 per year, so 3 years is $6,000. So in the 3rd year, you can put $4,000 in it. So which makes 3 years premium is $6,000. So you cannot be more than that. So that if you more than that is a MEC. So the reason here because for the universal life insurance, because you have a flexible premium payment. So if you say year 1, year 2, you put a $1,000, then $1,000. Then year 3, you have to just be careful. You can put a maximum $4,000 in it, right? So that's just something. If you own a universal life insurance, that's something you should should consider. So as I said, single premium whole life policy issued after June 21st, 1988 is a MEC. So so if you buy a single premium whole life policy, you will know it's a MEC. It's a MEC is if you take a withdrawal during the lifetime of the insured, then more likely you're going to be taxed. So that's something you need to know. So once the policy is classified as a MEC, so it's always a MEC. So even you later you not deposit more than you needed. So MEC is always MEC. So basically you subject to MEC taxation rules, right? So another thing you need to know, material changes. Say any life insurance policy, regardless when it is issued, is also subject to MEC testing. This is true even after its first 7 years if there's a material change to the benefits provided by the policy. So even your policy is not a MEC, but if you make a material change to it, the MEC be qualified as a MEC as well. So once the material change occur, a new 7-year testing period is started and a new 7-year MEC limit is calculated. So material change including following: the exchange of one policy for another, an exchange of insured, the increase of or addition of certain riders, the conversion of a term policy for a whole life contract, an increase in the future benefits, unless the increase is due to the payment of the premium to fund the lowest death benefit or due to the credit interest to those benefit. An increase of more than $150,000 over the death benefit payable October 20th, 1988. So you can see increase more than $150,000 over the death benefit. So would be a material change. Then a material change does not result from following a decrease in the future benefit. That's fine. An increase in the death benefit because of dividends, cost of living adjustment to the death benefit. So you can see what is material change. So the MEC rules apply to all the contract issued or contracts that have been materially changed on or after June 21st, 1988. Okay. Then what is considered material MEC withdrawals, right? Because we talk about MEC withdrawal, gonna be taxed. So policy distributions are withdrawals, loans taken as a cash or used to pay premium, and the dividend received as a cash or used to pay a loan. So you can see, if you do all of this, if you take a withdrawal as a cash, you take withdrawal to pay the loan, you dividend received as a cash, those are considered withdrawal is subject to the tax rule, right? Normally, dividends are treated as a tax-free return of excess premium paid in a participating whole life contract. So in a mutual company, those are tax-free. However, this is in a MEC, taking the dividend in cash is considered a taxable event. Then, as is electing to use the whole life dividend to offset outstanding loans. So, yeah. This rule will also apply if a distribution is kept by the insurance company to pay the premium. So, that's not a withdrawal. So, electing to use the dividend to pay up additions could defer the tax on the MEC dividend and could even eliminate the tax liability upon the death of the insured. So if your policy is a MEC, so you can do, you receive dividend, you receive cash dividend, you're going to be taxed, right? So if you use the dividend to buy the paid up additions, this can avoid the tax. So, however, you will see here, if it is kept by insurance company to pay the premium, that's subject to tax. If you buy addition, it's not taxed. This is another something, is like assignment or pledges. Any part of the MEC, if they are used to cover the burial expense or those funeral expense, if the maximum death benefit does not exceed $25,000, are also treated as are also not treated as a distribution. So